Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. I have gotten lots of suggestions by people to make a SoFi stock analysis, so that's what we're going to be doing today. If you don't know, SoFi is a fintech company. They offer student loans. They offer they have just a bunch of different financial services. Okay, I think most people know what it is. This is a $20 billion company founded in 2011, a PE of 35 now, and this stock had it's been all over the place, but at this point, it's at nearly the same price it was 5 years ago. Okay. And that's with the revenue. Let's see, in the last 5 years, the stock has gone from what, 1 billion in sales to now about 5 billion in sales. Yeah. And then net income has gone from being negative to being what, almost $600 million now, which that's always a thing I always like to frame it in that perspective because that makes a big difference. If your valuation is the same as it was 5 years ago, but the business is doing double the numbers and is twice as good, then that means you're taking out a lot of risk out of that investment. And that means that it's probably undervalued. Unless looking back, it was super overvalued, which in 2021, that's when a lot of stocks, especially fintech, were overvalued. So at 20 something dollars in 2021, that was overvalued for the company. And that's why when everything crashed in 2022, we saw this stock come down to $4 and it stayed in single digit range up until 2024. So that was a 2 year period of it trading, under $10. Okay, anywhere between $4 to $10. Then we saw a jump in 2025. It went all the way up to 30, and now we've lost that momentum and we're back down to this range where it hit 2024 and 2021. But like I said, even though $20 or 15 to $20 was overvalued in 2021, it probably is it's not necessarily overvalued right now. I wouldn't call it undervalued, but I don't think it's overvalued either. So we have PE of this is so it's you're paying 30 something times earnings for the trailing 12 months, but for this year you're paying about 23 times, and then for next year you're paying 19 times. And so we have 30% revenue growth, right? We have it's supposed to kind of drop off a little bit, but still decent numbers. 20% plus is still pretty good. EPS 0.4 last year to zero point 0.6 this year, and then 0.8. Not anything crazy, but it's good. But members, products, net income, let me rephrase this again. Let's go back to quarterly. Things are looking better. Compare this Q1, 166 million to this Q1, 71 million. They did over a double X from the other Q1 to this Q1. Take it back to the other Q1, so Q1 2026, 2025, and Q1 2024, they did 88 million, and then it did die down in 2025, and then now it's way back up. So that's good. But I'm going to need to see a little bit more progress here, a little bit more growth or a lower valuation for me really to be confident and bullish on this. The free cash flow thing we can't pay attention to because I'll get into that in a second. Cash to debt is good. This is one thing I do like. It's a very solid cash to debt position. This is a big turnoff for me. Shares outstanding is up 16% in the last year, even though this company is profitable. So I don't like that. That's a big reason why the stock is down. We come over here to valuation. Price to earnings is definitely in a healthier spot, but nothing great. 35 times earnings for a company that's going to be growing. I guess, let's see, that's 50% EPS growth, but then it's going to slow down to 33% EPS growth. And then who's to say it's not 20 or 25% in 2028? That happens a lot. So just keep that in mind. Price to sales is important to look at here because it's one of they're not too profitable or positive with free cash flow either. But price to sales of about a 4 right now. It's just okay. It's okay. I'm not going to call that again, it's not overvalued, but it's not undervalued. It's like fair. And again, market sentiment and the way investors view it is they kind of choose what the sentiment is. So let's get into the free cash flow because SoFi acts like a hybrid between a tech company and consumer bank. Traditional valuation metrics like free cash flow will mislead you because typically it's operating cash flow minus capex, and that works for most companies. But since SoFi holds a bank charter, banking institutions structure or free cash for banking institutions, free cash flow is meaningless because of how accounting classifies these loans. Loans are treated as cash outflows. So all that means is that let's say they loan out $1 billion or $3 billion even. Well, if they have operating a positive operating cash flow of let's say 1 billion, but they give 3 billion out in loans, then the free cash flow is going to be negative then, right? But giving out a loan is something that they're most likely going to make money from, right? They're going to earn interest on that. So it's actually that's why we see sales growing. If we get back into this, deposits are structural funding. When you or other members deposit money into SoFi, that cash is coming in classified as a financing activity, not an operating cash flow, which is actually that's the other thing. I think that's why you also can't really pay attention to the cash to debt necessarily, because all the money that they're getting from people that people are holding in their accounts, that's on their, that counts as cash. So therefore, SoFi's originations are growing aggressively, reaching over 12 billion for this past quarter. Okay, 12 billion. So let's see here. Originations are growing aggressively. The cash is in the door to fund those interest earning assets. So what that makes me think is, okay, if they're doing, how does this make any sense? If they did a 1.4 billion in sales, but they had 12 billion go out the door, shouldn't the free cash flow be negative 11 billion? That's one thing that doesn't make a whole lot of sense to me, but whatever. I could research that later. Then we have, it doesn't mean SoFi is burning cash in the business. It means they are actively deploying capital into primary revenue generating mechanism, writing loans. While top line net revenue has grown 41% year over year, GAAP net income can appear stagnant, and this occurs for three reasons. C, current expected credit losses accounting. Under banking regulations, the moment SoFi originates a loan, they must immediately provision for the lifetime expected credit loss of that loan up front. They take a large non-cash hit to net income on day one, where this actual revenue from interest is realized slowly over the next several years. Rapid sales and origination growth actually create a temporary drag on current net income. That's probably that seems to be the main thing. That's what's happening right now. They also shifted from a pure originate to sell model, where they quickly packaged and sold loans for immediate fee revenue, to now a hold to maturity model funded by their cheap deposits. Holding loans yields much higher lifetime profitability, but it smooths out the earnings. Instead of a sudden spike in fee income, the profit rolls in sequentially over time as net interest income. That's good. And that's where, even though their EPS growth is like slowing a little bit, it's probably going to be more consistent. Investment in non-lending verticals. They have actively reinvested gross profits from lending into scaling its financial services segment. SoFi Invest, Money, credit card, the tech platform, revenue jumped 41%, and it's hurting whatever, GAAP net income and free cash flow. But their GAAP net income was 166 million, up 134%, making its 10th consecutive quarter of GAAP profitability. Great. What is their moat? The financial product flywheel, low cost deposits, high yield savings, high LTV lending, and cross buy products. The bank charter cost advantage. By obtaining a national bank charter, they can sweep up low cost member deposits, paying out competitive yields, and use that exact cash to fund its high yield personal and student loans. So it's pretty much like a pyramid scheme. They're borrowing other people's money and then loaning it out to others. But no, I'm just kidding. This eliminates their reliance on expensive third-party warehouse lines of credit, creating an unmatched cost of funds advantage over unchartered fintech competitors. They target high-earning, not yet rich consumers. Once a member sets up direct deposit, they cross-sell a mortgage, credit card, and investment account at zero incremental customer acquisition cost. That's good. 43% of new product adoption came from existing customers. Okay. They own the underlying core banking software architecture that powers other fintechs. I read about this recently with another company, but they actually, I think it was Upstart or somebody, they actually stepped off of it though. This vertically integrated tech stack reduces their own internal operating costs per account to pennies while giving them a business-to-business enterprise revenue stream. Yeah. The 5 year outlook. Top line revenue is expected to be 15 to 20% over the next 5 years. And that's probably what we'll see in 2028 to 2030. Because the upfront infrastructure costs are already paid for, operating levels will kick in heavily, causing net income and EPS to grow at a faster rate than sales. If that's the case, how come it's growing way slower than in next year? We're looking at EPS roughly of 0.7, 0.6 maybe. That's what they have for 2026. And then 5 years from now, we're looking at about $1.35, which is, let's see, do they even have that number in here? Growth estimates, SoFi. Yeah, so And then it says down here that it's most likely to settle about a 20 PE. Keep in mind, that's not a lot. That's like what the market trades at. And if so at a $1.35 forward EPS, keep in mind that's 2031 we're talking here. So if they're right, 20 times earnings in 2031 times $1.35 EPS means a $27 stock. Okay. So that's like what? I don't know. 90% gain on your money over 5 years. That's not that good for it's not bad, but you could get that in the index. So it doesn't make sense to take a bunch of risk on with just one company. That's why I don't think I would buy this now. I would have to see it at like probably like 20 times earnings where it is now, meaning like, so if they do zero point 0.6 of EPS this year, I would get it at like 12 or under. That's kind of, that would be like the mark I'm looking for, is right around like $12 or under. So that is my stock analysis for SoFi. Let me know what you guys think down below, and I will see you in the next video.